Okay, so let's talk about something pretty interesting in the world of accounting. When one company invests in another, it's not always a simple, passive thing. Sometimes they buy enough of a stake to have a real voice, real influence. So, how do you put a number on that? How do you account for it? Well, that's where something called the equity method comes in. And that's exactly what we're going to demystify today.
So, here's the game plan. We'll start with why this method even exists, the kind of in-between investment it's for. Then we'll hit the magic rule of thumb, the 20 to 50% rule. We'll break down how the method actually works, step by step with a real example, see how it shows up on the financial statements, and then we'll wrap up with a quick quiz to make sure you've got it down.
All right, let's dive right in. It all starts with a very specific kind of situation, this idea of an in-between investment. I mean, think about it. This is the core puzzle, right? You're not just a tiny shareholder along for the ride, but you're also not calling all the shots. You're in this gray area, this middle ground of having influence. And that kind of special relationship needs a special accounting treatment. So, how do we know when we're in that gray area? Well, luckily for us, accountants have a pretty clear guideline to help define what it means to have significant influence. And this chart here just lays it out perfectly. Look, if you own less than 20%, you're generally considered to have little influence. If you own more than 50%, well, you're in control. And that's a whole different story called consolidation. The equity method, it lives right in that sweet spot, that 20 to 50% zone. That's where we presume you have what's called significant influence. So, that's the key term you got to remember, significant influence. And it gets triggered in that 20 to 50% range. But notice the really important detail here. It's about voting interests. We're talking about common stock, the shares that give you a seat at the table. Any non-voting stock doesn't count towards this calculation at all. Okay, so we know the when. Now let's get into the nitty-gritty of how. How does this thing actually work on the books? It really boils down to three key moves. First, nice and easy, you record the investment at what you paid for it, the original cost. Now here's where it gets interesting. That investment account on your balance sheet isn't static, it's alive. It goes up when the other company makes money, and it goes down if they have a loss. And finally, and this is the part that trips a lot of people up, when you get a dividend, it's not income. Nope. It's treated as a return of your investment, so it actually reduces the value of your investment account. Okay, that's a lot of theory. The best way to really get this is to see it in action. So let's walk through a quick example. So let's set the scene. You've got Company P, and on May 1st, they buy a 30% chunk of Company XYZ for 200 grand. Right there, that's step one. The investment is on the books at its cost, $200,000. Okay, now for step two. Year end comes, and Company XYZ reports $60,000 in profit. Awesome! But, and here's a little catch, Company P didn't own the stock for the whole year, right? They bought it in May. So they only get to claim their share of the income for the 8 months they were actually an owner. So how does the math work out? Well, you take that $60,000 income, but you only look at the 8 out of 12 months portion, which is $40,000. Then you take Company P's 30% cut of that, which gets you to $12,000. So that $12,000 gets added to Company P's investment account, bumping up its value. Okay, let's jump ahead to year 4. It's a good year for XYZ. They made $100,000 in net income. And on top of that, they decided to share the love and pay out $20,000 in dividends. So now we've got two things happening to Company P's investment account. First, the income. 30% of $100,000 is $30,000. That pushes the investment's value up. Then you've got the dividend. 30% of $20,000 is $6,000. And remember, that dividend pulls the investment's value back down. So we've seen how the numbers get crunched behind the scenes. But where does an investor or an analyst actually see all this stuff? Let's take a look at the financial statements. It's pretty straightforward, really. On the balance sheet, you'll see that investment line item. And you'll know it's a living, breathing number that's constantly changing. Over on the income statement, you'll see a single line for the investor's share of the earnings. And finally, on the statement of cash flows, the actual cash spent to buy the investment or the cash received from selling it shows up in the investing activities section. All right, you've seen the theory, you've seen an example. I think you're ready. Let's do a quick check to see if you can put these rules into practice yourself. Okay, here's the scenario. Larkin Company owns a 25% stake in Devon Company. The investment account starts the year at $200,000. Now, during the year, Devon knocks it out of the park. They earn $600,000 in income and pay out $400,000 in dividends. So, what's the investment worth at the end of the year? Take a second, think it through. You've got your starting number, you know what to do with the income, and you know what to do with the dividends. What's that final balance?
And the answer is $250,000. If you got that, fantastic. You have totally nailed the mechanics of the equity method.
And for everyone else, let's do a quick recap. You start at $200,000. You add Larkin's 25% share of the income, that's $150,000. Then you subtract their 25% share of the dividends, which is $100,000. Do the math and you land right at $250,000. Simple as that. You know, when you really think about it, this quote says it all. The equity method isn't just about following some arbitrary rule. It's about making the financial statements tell a more truthful story, a story about the economic reality of having real influence over another company.
And that is the biggest thing to take away from all of this. Instead of just letting an investment sit on the books at what you paid for it, this method gives you a much more accurate, up-to-date picture of that asset's real economic value to the company. It's way more dynamic.
So I'll just leave you with this to chew on. The next time you're looking at a company's balance sheet and you see a big investment line item, you can ask a smarter question. Is that just a passive stock holding, or is it a dynamic relationship reflecting real influence, with its value changing every single quarter? It adds a whole new dimension to your analysis.